Triple Net Investing 101, everything you need to know about triple net leases. What if I told you there's a way to invest in commercial real estate where your tenant pays for basically everything? The property taxes, the insurance, all the maintenance. You just collect a check every month. Sounds pretty good, right? Well, that's exactly what triple net lease investing is all about. And it's becoming one of the most talked about strategies in Houston right now, especially for people who want to build wealth without becoming full-time property managers. Stay tuned to find out more. Hey everyone, I'm Tello, and welcome back to my channel where we break down Houston real estate like nobody else. Here's the thing, while triple net investing might seem simple on the surface, there's a lot more to it than most people realize. And if you don't understand the details, you could end up making a very expensive mistake. So today, I'm breaking down everything you need to know about triple net leases using real numbers from our Houston market in late 2025. So you can decide if this is the right move for you. What is a triple net lease really? All right, let's start with the fundamentals because this is where a lot of people get confused. A triple net lease is different from a gross lease. And a gross lease, which is what most residential landlords are used to. You can charge a rent and then you can pay all the expenses out of that. Taxes, insurance, maintenance, repairs, everything. Your net income is whatever's left after all those bills. But in true triple net lease, which is what we're talking about today, the tenant pays a base rent plus 3 additional nets: property taxes, building insurance, and most or all of the maintenance and operating expenses. So you're getting a much cleaner, more predictable income stream. Here's what that looks like in real life. Let's say you buy a triple net property for sale here in Houston, maybe a single tenant building like a fast food restaurant or a pharmacy. The tenant might be paying you $15,000 a month in base rent, but then there's also cutting a separate check directly to Harris County for property taxes, paying their own insurance premiums, and when the HVAC needs servicing or the parking lot needs repaving, that's all on them. You as a landlord, you're basically just responsible for mortgage payment if you have one and making sure the building is still standing. That's it. It's about as close to passive income as you can get in real estate. Now, these leases are usually long-term. I'm talking to 10, 15, sometimes even 20 years. With predetermined rent escalations built in, that might be 2% a year or tied to CPI. So your income is going up steadily over time, which is fantastic for combating inflation. But, and this is a big but, you're also locked in. If market rents in Houston shoot up because of something like the huge population growth we're seeing, you can't just raise the rent to match the market until that lease expires. So there's a trade-off there that you need to understand. The tenant is everything. This is probably the most important thing I'm going to tell you today, so listen up. When you're looking at triple net lease tenants, the quality of that tenant is more important than the location, more important than the building itself, and definitely more important than the cap rate you think you're getting. I cannot stress this enough. In Houston right now, we're seeing a lot of different types of tenants doing it, triple nets, leases, everything from national drugstore chains like CVS and Walgreens, the dollar stores like Dollar General, to quick service restaurants, auto parts stores, and even medical offices. The reason tenant quality matters so much is that your entire investment is basically a bet on that one company staying in business and paying rent for the next 10 to 15 years. If they go bankrupt or decide to close that location, you're stuck with an empty building that might be very difficult to release. And here's where it gets tricky. Just because it's a big national name doesn't automatically make it a great tenant. You need to look at their actual financial strength, not just the brand recognition. Let me give you a real example. In 2025, we're seeing some retail sectors under pressure. Some traditional retailers are struggling with e-commerce competition, but essential services, think pharmacies, grocery stores, medical offices, these are much more resilient. Dollar stores are also expanding aggressively in Houston area because they serve a need that Amazon can't easily replace. So when I'm helping my clients evaluate a potential triple net property for sale, the first thing I look at is the tenant's credit rating. Is it investment grade? Are they a franchise, or is it a corporate guarantee? A corporate guarantee from a national chain is way stronger than a franchise guarantee from a local operator. I also look at their sales per square footage if that data is available. And I try to understand their business model. Is it durable? Is it something that's going to be around in 10 years? These are the questions you have to ask. Underwrite the lease, not just the building. This is where a lot of people make mistakes. They fall in love with a beautiful building in a great location. Maybe right off at 610 Loop in a hot inner loop neighborhood, and they forget to really dig into the lease itself. But the lease is your contract. It's your protection. And it determines whether this is actually a good investment or a money pit waiting to happen. You need to read that lease carefully, preferably with a good real estate attorney who understands triple net leases. What you're looking for is confirmation of which expenses are truly shifted to the tenant. Does it include property taxes, insurance, common area maintenance? What about capital items like roof replacement or HVAC system replacement? What about structural repairs? Some leases are what we call absolute triple net, where the tenant truly pays for everything. Others have carve-outs or caps that could leave you holding the bag for big expenses. For example, I saw a lease recently where the tenant was responsible for maintenance up to a certain dollar amount per year. But anything beyond that, the landlord had to pay. That's not a true triple net lease, and it changes the math completely. You also need to check the lease term remaining. If there are only 3 years left on the lease and the tenant has a great option to renew at the same rent, that's a very different investment than a property with 12 years remaining on the lease and 2% annual rent bumps. And speaking of rent bumps, that's another thing people don't pay enough attention to. In Houston's market right now, good triple net leases should have rent escalations of at least 1.5 to 2% per year or tied to CPI. If it's a flat rent for the entire 15-year, you're actually losing money to inflation every single year. I always tell my clients to look at the whole picture. What's your total return going to be over the life of the lease? Not just what the first year's cap rate looks like. The advantages that make this attractive. So why are so many investors looking at triple net lease advantages right now, especially in a market like Houston? Well, there are some really compelling reasons. First, it's about a passive as real estate gets. Once you buy the property and the lease is in place, there's a very little for you to do. The tenant handles the day-to-day management, the repairs, the maintenance costs. You don't get those 2 a.m. calls about a leaky toilet. For busy professionals, people relocating who don't want to be hands-on, landlords or sellers who are used to headaches of residential property, this is a huge relief. Second, the income is predictable. When you have a 15-year lease with a credit-rated tenant, you pretty much know exactly how much money is coming in every month for the next 180 months. That's incredibly valuable for retirement planning, for 1031 exchanges where you need to replace income, or for anyone who just wants stability. In our Houston market, where a cap rates for triple net properties are currently running in that 5.5 to 6.5% range, that's a solid return for something that's essentially hands-off. Third, it's a great inflation hedge. With those built-in rent escalations, your income is going up every year. So while your mortgage payment stays the same if you financed it, or your rental income is increasing. That's building equity in two ways, through loan pay down and through rising income. And in Houston, where we're seeing steady job growth and population influx, that inflation protection is really valuable. Fourth, there are tax advantages. You still get to depreciate the building even though you're not actively managing it. And if you do a cost segregation study, you might be able to accelerate some of that depreciation. For someone selling a highly appreciated property in the inner loop and doing a 1031 exchange, that tax deferral combined with depreciation benefits can be really powerful. And finally, these properties are financiable. Banks love triple net properties with strong tenants. You can often get 65 to 70% loan to value, sometimes with non-reoccurrence financing, which means you're not personally on the hook if something goes wrong. In late 2025, we're seeing interest rates for these types of properties in the 5.75 to 6.5% range, which is much more reasonable than what we saw in 2023 and early 2024. The downside nobody talks about. Now, I always tell my clients that if something sounds too good to be true, it probably is. And triple net lease disadvantages are real. And you need to understand them before you jump in. The first and biggest risk is tenant default. If your tenant goes bankrupt, and even big national chains can go bankrupt, you're not getting rent. And with a single tenant buildings, that means zero income until you find a new tenant. That could take months or even years, depending on the location and the building. The second risk is leasing difficulty. Let's say your 15-year lease ends and the tenant decides not to renew. You now have to find a new tenant, and that might not be easy. If it's a specialized building, like a fast food restaurant with a specific layout, you might be limited to who can use that space. And if the market has changed, you might have to offer tenant improvement allowances or lower rent to get someone in there. That's why location is so important. Even with a triple net lease, you want to be in areas with strong demographics and multiple potential uses. The third risk is concentration risk. When you buy a single tenant triple net property, you've got all your eggs in one basket. One tenant, one location. If something happens to that tenant or that specific market, you're exposed. All the growth we're seeing, you're stuck with that slower growth rate until the lease expires. You're trading upside potential for stability, and that's not the right move for everyone. And finally, these properties can be expensive because they're so desirable for passive investors. The cap rates are often lower than what you'd see on multifamily or office building. You're paying a premium for that stability and low management. So your cash on cash return might be as high as you'd expect, especially after you factor in higher purchase price. Working the numbers, let me walk you through how to actually analyze one of these deals, because this is where the rubber meets the road. First, you need to determine the property's net operating income, which is a true triple net lease, is essentially just the base rent. So if annual rent is $180,000, that's your NOI. Then you look at the asking price. If they're asking $3 million, that's a 6% cap rate. Simple enough, but here's where you need to dig deeper. You need to look at the tenant's financials. What's their credit rating? What's their debt service coverage ratio? You need to understand the lease structure. Are there any landlord responsibilities? Some leases are with what we call bondable triple net, where the tenant truly pays for everything, including structural repairs. Others have carve-outs where you might be responsible for the roof or the foundation. You also need to look at the rent escalations. If it's 2% a year, in year 10, that rent is going to be significantly higher than year 1. So you need to look at your internal rate of return over the full lease term, not just the first year cap rate. There are triple net lease calculator tools online that can help with this, but honestly, you want to work with a broker who really understands this stuff, and you need to stress test it. What happens if the tenant leaves? What would it cost to get a new tenant? How long would it take? What's the property worth vacant? These are the kind of questions that separate good investments from bad ones. Real Houston examples. Let me give you some real triple net lease examples from what we're seeing in Houston right now. In the inner loop, we're seeing a lot of quick service restaurants. Think Chick-fil-A, McDonald's, Taco Bell, doing triple net leases with 15-year terms. These are typically trading at 5% cap rates because they're considered very safe. The tenants are strong, the locations are good, and these businesses tend to do well even in economic downturns because people still need to eat. We're also seeing a lot of medical office buildings, especially near the Texas Medical Center, but also in suburban areas. These might be leased to a large healthcare system or a national dental chain. These are attractive because healthcare is relatively recession-proof, and with Houston's growing population, demand for medical services is strong. Dollar stores are another big one. Dollar General and Family Dollar are aggressively expanding in the Houston area, including in the inner loop and inner suburban areas. These typically trade at higher cap rates, maybe 6 to 7%, because some investors are concerned about the long-term viability of dollar stores. But they're actually doing very well, and they service a need that e-commerce can't easily replace. Pharmacies are the golden standard. A CVS or Walgreens on a corner lot in a good location, those are considered very safe investments. They typically trade at 5 to 5.5% cap rates, sometimes even lower for the best locations. These tenants have investment grade credit. They're essential businesses and they tend to stay in locations for decades. And then there are some more specialized uses. Car washes, auto parts stores, early childhood education centers. These can be good investments, but you really need to understand the specific tenant and their business model, financing, and the market in 2025. Now let's talk about what's happening right now in our Houston market, because this is really important. As of December 2025, we're in a much better financing environment than we were in 2023 and 2024. Interest rates have come down. The Fed cut rates in September, and we're seeing financing for triple net properties in the 5.75 through 6.5% range. That's still higher than the pandemic lows, but it's manageable. The spread between cap rates and interest rates is actually workable again. In Houston specifically, cap rates for triple net properties have stabilized for the highest quality tenants in the best inner loop locations. You're looking at 5 to 5.5% cap rates for good but not investment grade tenants, maybe 6 to 7%. Even more specialized or secondary locations, you might see 7 to 8%. The key is that the market has found some equilibrium. Sellers aren't expecting those 4% cap rates from 2021 anymore, and buyers can actually make the numbers work. The transaction volume is up significantly in 2025. According to recent data, Houston retail investment sales are up nearly 50% year over year. People are getting more comfortable with pricing, and there's a lot for 1031 exchange activity as investors sell appreciated properties and look for replacement investments. The inner loop is particularly active because of the strong demographics and limited supply of good triple net properties. Is this right for you? So here's my honest take as someone who works with relocation clients, investors, and sellers in inner loop every single day. Triple net lease investing can be a fantastic strategy, but it's not for everyone. If you're looking for maximum cash flow and you're willing to be hands-on, you might be better off with a multifamily property where you can force appreciation and raise rents more aggressively. If you're looking for a quick flip, this isn't it. These are long-term holds. But if you're a seller who's tired of management headaches and you want to do a 1031 exchange into something truly passive, this could be perfect. If you're relocating to Houston and you want to park some money in a stable local investment while you rent and figure out where you want to buy your personal home, this is a great option. If you're a busy professional who values your time and wants a predictable income without the drama of property management, triple net leases should definitely be on your radar. The key is working with someone who knows the Houston market, understands these leases inside and out, and can help you evaluate the tenant quality, the lease structure, and the long-term viability of the investment. Don't just look at the cap rate. Don't just fall in love with a location. Really dig into the details, because that's what separates successful triple net investors from people who end up with expensive problems. Conclusion. Look, I've been helping people buy and sell real estate in the inner loop for years. And I'm seeing more and more of my clients move into triple net investing because they're drawn to that passive income and stability. And in our Houston market, with the growth we're experiencing, the strong job market, and the diverse economy, there are some real opportunities out there. But you have to be smart about it. You have to do your homework on the tenant. You have to read the lease carefully. You have to understand what you're actually buying, not just the headline numbers. And you need to make sure it fits your overall investment goals and timeline. Thanks so much for watching. If you're thinking about exploring triple net properties for sale in the inner loop or anywhere in the Houston area, I'd love to chat with you about what's out there right now. There are some interesting opportunities, especially for cash buyers and those doing 1031 exchanges. And if you're selling a property and thinking about moving into something more passive, we should definitely talk about how that transition would work. I'm Linda Tello, and I specialize in helping buyers and sellers navigate Houston's inner loop neighborhoods. My contact information is in the description below. Whether you're relocating, investing, or selling your current home, I'm here to guide you through every step for a smooth transaction and successful closing. Get in touch with me to know more about Houston real estate. See you in the next video.